All right, we are live. Thank you so much for joining me, and I should say us, in today's video. I'm joined by Jim Black. Are you there, Jim? Jim must be having technical issues right now. I'll hide him right now. There you go. Are you there, Jim?
There we go. I'm here. Yep. Can you guys hear me?
He is alive.
All
Jim
right.
Black, the man, the myth, the legend. Even though you're a little bit late, buddy, but hey, we're good. How are you doing, Jim?
I'm doing great. How you doing today, Jace? A little technical
I'm
difficulties.
doing awesome.
Yeah. Thanks for having me on again.
Everyone, thank you so much for joining. So these videos, we're trying to do these every single week with Jim. Jim has been my longtime friend for about 2 years now.
Yeah, pretty close. Yeah, brand new.
About 2 years, yeah. I thought I'd make these videos for you guys to answer your questions because we get so many comments on my channel, and I would love to answer all your questions. So I want to do this live stream for you guys every single week to answer your questions. And Jim and I are going to be talking about a topic. And of course, today's topic is what will happen when mortgage rates fall. So that's a big question. And so I'd love to hear from you guys. Let's just kind of look at some comments real quick. Steve, a longtime subscriber of my channel. He's like #1 commenter on my channel. Comments the first one every single day. I don't know how you do it, Steve, but thanks for joining us today. Let's look at what else we have here. Anyone else have any questions? Yeah. So if anyone has any questions, then just put in caps question and then your question. That'll be easy for us to see if you guys have any questions. But yeah, Jim, I guess it's like at a high level overview. I mean, we're talking about this higher for longer interest rate environment in which we're not seeing inflation winding down very much. But we do have a lot of reports being announced this week. So this is Tuesday. If you guys are not watching this video on Tuesday, April 9th, this is a live stream we're doing from 4 to 5 p.m. So if you're watching it after that, it's a pre-recorded video for you. In any case, there's a couple of reports that are being announced this week. So tomorrow we have the CPI, or the Consumer Price Index, a measure of inflation, which is one of the measures that the Fed watches in order to change any monetary policy going forward. A lot of people are talking about the Fed decreasing rates this year. Late last year, a lot of people were talking about how the Fed was going to start decreasing rates in March. And here we are coming up on May next month. And the Fed still hasn't done any decreases or cuts to interest rates. So in any case, we're kind of in this like environment in which we have this higher for longer interest rate environment, which of course is keeping mortgage rates fairly high as well. Crystal, thank you for joining us in today's video. Pacifica, right on. Close to Jimbo. Jim's in Santa Cruz area, where I went to school at UC Santa Cruz. Go Fighting Slugs. Anyways, so yeah, I'd love to hear from you, Jim, and I'm sure a lot of people would love to hear from you as well, since you've been a loan officer for coming up on 1 year next year, I think. So
yeah, I'm brand new. I just got my license yesterday. So yeah, I just got it yesterday. Yep.
Yeah, all right. Jim's you've been a licensed loan officer for what, 22 years?
22 years. I've been fortunate to help about 8,500 families with home ownership, and every solution is different and unique. And that's what makes it fun to come to work. So a lot of people don't look forward to this industry or being part of it, but it's all different every day. And that's what makes it really exciting.
Oh, for sure. I mean, remember when I used to be a personal banker at a large bank? I would just like sit there at my desk waiting for someone to walk in.
That music playing over and over again, just the same music.
Was there music? I can't remember if there was or not, but yeah.
You were so focused on helping someone open a checking account, I get you.
Yeah, I love being a real estate agent. I love being a real estate agent much more so than being an accountant. Nothing against accountants. I guess hey, Kevin, how you doing, buddy? Kevin's been a longtime subscriber as well. And Jay will get to your question as well. Jim, what's your take on what will happen to our housing market when rates actually do fall?
Sure. So I like to give sometimes acronyms for our industry. There's a lot of initials and hyphen words and things of that nature. And so I like to always share one that always is really easy to remember as a consumer. 1% difference in interest rate equals an 11% difference in buying power.
Increase.
And if rates go higher by 1% or lower by 1%, The difference is about 11% buying power. So just keep that in mind. Whatever rates do, think about all the millions of people that are out there and how interest rates can affect someone either in a good or bad way. So interest rates have unfortunately not had an easier downward push because of the fact that all this positive economic news continues to surprise us and the Fed also. Everyone thinks that there's going to be a major correction in interest rates where the Fed's just going to drop rates. The word drop is, I think, a really bad analogy to use because to me, they're not going to drop something dramatically overnight. That would require a major financial impact, like a major recessionary indicator. So I think you're going to see a leveling off of rates or possibly a slide down to better rates, but it's not going to be this like one day rates are 7 and now they're 5. So we need to first understand what's going on with how the Fed looks at rates and what their goal is. The Fed's goal is to keep consumer confidence at a certain level to make sure that there's no inflationary pressures or deflationary pressures. They're trying to keep a stable market of equilibrium where we're trying to make sure that we don't create skyrocketing prices for fixed income seniors. And we're also not lowering rates so quick that it actually can create some stress in the purchasing power of people in a good way. Sometimes you could have rates drop so dramatically that people way overconsume because now the cost to borrow money has gone down so fast. So the goal really of the Fed is to ease into things no matter what they do. What they're trying to do when they communicate to us citizens of the United States or to the global markets is to give them indicators that they're looking at and their forecasts of what they're planning to do if the data comes out the same way that they're currently getting it. Well, what's been really hard recently is that data keeps coming back, conflicting each other. It's a contrarian situation with rates right now, where you have a core index come back better or worse, or job losses are better than worse than expected, and that's spiking markets to react. Remember, financial markets like the stock market, the bond market, those are speculative markets. They're planning on future outcomes when they make their choices on investments. So they are taking speculative information to be able to look at ways to buy or sell something. So my opinion right now of interest rates, I think we're in a trading range, which means if you can go, Jason, by the way, to a 10-year, is that the 10-year index? Or if you could pull that up, that'd be fantastic.
Yeah, this is kind of the economic calendar because you're kind of talking about like the environment. And so I just brought this up because we have the core CPI being announced on Wednesday. Thursday, we have PPI, which is what producers pay. That's the inflation measure as well. But you want to see the 10-year, you said?
Yeah, if you give me a 10-year treasury, a 10-year, like a 6-month look at a 10-year, would that be great? The 10-year treasury bond is a good indicator as to where rates are and where they're operating at. So right now, today, for example, the index closed at 4.362, down by 0.004 basis points.
Yeah, flat.
If you look at interest rates, and by the way, I used to be a trader on Wall Street. I'm no longer an actively licensed trader. So this is not financial advice. This is not telling you to buy or sell something. It's just trying to show you indicators on how rates move. So I just want to make sure I'm clear on that before we go any further. But as you can see, where Jason is right now on his chart, which is about October, I think that says 18th, 2023.
Yeah, October 18th.
You can see that was the highs of the highs, where the index was almost at 5%. That index has come down and to its lowest in the beginning of December or January of 2024 at 3.789%. So that's a big drastic change in a short period of time. That would be my best example of how far rates could drop, right? When you say drop, that's pretty much the only analogy I would use for rates dropping. That's a full percent and almost a quarter differential in the index, which should relate almost to the same rate change. So in that example, we saw a dramatic increase in opportunity to borrow money at a cheaper amount. In that example, people got about 13 to 14% more buying power in that limited window of time. I bet you if you looked at that rate drop and compared it to the houses under contract and how fast they closed and how much they sold for, I bet it was probably a higher number. Because again, if rates are lower, I have more buying power. I can buy more of something. So those properties probably in that same period of time had an increase in overall sales price average. So it's purely a supply and demand factor that we need to think about. So
Yeah,
I
absolutely.
look.
Go ahead. I was going to
So when
talk
I look
about
at
that.
when I look at things, also another fundamental thing. I studied economics at Cal Poly San Luis Obispo. Went to grad school and studied financial markets and economics. So I've studied this for a very long time. One thing that the fundamental thing right now that we all need to think about is purely supply and demand of housing. Right now, there is a shortage of housing. For example, today, Home Depot is doubling down on their bet that they think they need to get more supplies to build homes. So they're making investments in companies that can give them more lumber, more supplies, more materials to build housing. So if you think of this purely as just a supply and numbers game, rates moving higher or lower does not fundamentally change the ability for a builder to build a house tomorrow to catch up to that inventory need. It also does not have the ability to turn off building a house if rates go up too high. The fundamental need is more housing. And so with that fundamental thought, rates changing is not going to really affect the price of the home as much as we think it will. And I'll let you talk about the next segment.
Yeah, well, I was going to say that Home Depot also announced, I think it was either today or yesterday, that they're actually going to be selling tiny houses as well. So I don't know if you
Yeah.
saw that.
Yeah.
So
And
they're not only had purchased that company for helping pros, but also they're trying to sell these EDUs basically as well, which come in pieces. You put them together when they arrive. But I found this article from what's this CBS News. It says, what will happen when rates fall? When rates begin to drop, buying a home typically becomes more affordable. Should rate cuts occur in 2024, home buyers may qualify for larger loan amounts or find that their monthly payments are more manageable. And that's exactly what Jimbo was talking about. When rates decrease by 1%, your purchasing power increases by 11%. So when rates decrease, housing becomes more affordable because your payment is less, all other things being equal. It says with increased affordability, however, comes increased demand. As interest rates inevitably decline, it's a matter of when, not if, we can expect a demand, or we can't expect demand to surge. And of course, we all know what happens when demand increases. That puts upper pressure on home prices. The downside of having interest rates decrease to get more buyers coming off the sidelines.
There's another stat. There's another stat to be aware of, that every 1% decrease in interest rates, about 5 million more millennials can qualify to buy a home. So if rates go down 2%, let's say there is that magical drop in rates, that means 10 million more people should be looking to buy properties or can now qualify. We're not building 10 million, not even 1 million new units per year right now. So that should tell you that I don't personally believe values are going down, especially with the fact that costs to build have gone up, the fact that contractors are becoming less and less more available. They're retiring. They're not coming in this industry. And permit processes are now a much longer process for most counties, cities, states to get things done. So I'm personally doing a property right now in Wisconsin. It's a large 703 unit property and project. It's been in process to get it approved for the last 3 years. So it takes time to do that. So when you have a lagging supply and a demand that can be turned on overnight by an interest rate fluctuation, it tells me one thing. It doesn't matter what happens with rates, the values are not going lower. And again, if I lived in a big area that had a lot of farmland around, maybe that would be someplace I may avoid buying in, because maybe that farmland gets rezoned as more units. So I would say that in most geographical hubs where there is less building options available, you're going to see even less of a factor in housing potentially going lower, because I think it's possible.
Yeah. All right. So let's get to some questions because there are some questions up here. So JK has a question. How is California real estate market doing? Is April starting to see more activity? So in general, in California, I imagine this is probably pretty true across the nation. You tend to see more houses being listed for sale in April and May. I think in Sacramento, we peak regarding the amount of houses being listed for sale around May each and every year because it's spring home buying season, right? We're seeing more houses being listed for sale and also more home buyers as well. So what I'm personally seeing in Sacramento, for example, and of course I follow, California, Florida, Texas, et cetera. I'm seeing that it's kind of a dichotomy, right? So talking about existing houses, I'm seeing houses that are updated, priced right. They're not trying to set, records. Then oftentimes they're getting multiple offers, even though we have 7% rates. So I'm seeing that, but I'm also seeing houses that are overpriced. They need work, and the cost of remodeling right now is so expensive. So I'm seeing those houses sitting in the market. So we are seeing a competitive market, but not nearly as crazy as it was in 2020 through the spring home buying season of 2022. But Jim's located in a different market than I am. You're located in the Central Coast around the Santa Cruz area. What are you seeing in your neck of the woods?
Yeah, unfortunately, homeowners, congratulations. You keep getting more appreciation in our marketplace because you can't build more land. So where I live directly west of Silicon Valley. So Santa Clara County, where San Jose is, all those Santa Clara, Cupertino. A lot of people are making lifestyle decisions to move to areas that aren't necessarily good financial decisions. So lifestyle decisions sometimes are the personal preferences of maybe a baby boomer who's retiring, who's an empty nester, someone who may want a change of pace of life, someone that can work remotely. So I think in my area, there's not the ability to build more land. So you're seeing properties get rezoned and a larger parcel is now being cut into smaller parcels, or now there is the ability to put a ADU on the property, an accessory dwelling unit, or a tiny home on the property. So just know that as the movement to a lifestyle change, in this example where I live in Santa Cruz County, it's a beach town, and a lot of people are coming here that have wealth, and it's still a discount relative to some of the Bay Area markets. So sometimes people will move just for the quality of life difference also. If you can buy a 4,000 square foot home in Sacramento versus a 1,000 square foot condo in Oakland, that might be a choice you make to raise your kids in a better environment or have more house or less of traffic. All those preferences play a role. And with the shift in a lot of people working remotely, that's been something that people have been able to do. But you're also seeing big markets like Austin, Texas, in my opinion, having big challenges right now. They grew very dramatically during the COVID times, where a lot of Apple employees and other tech companies relocated people, and they said they could work wherever they wanted to. They used that Austin market as a hub where they were able to then relocate. And now those jobs are being kind of called back to the Bay Area. Hey, you know what? We can either adjust your pay to the cost of where you're living, or you can come back to the Bay Area where we're paying you a significant amount more money to live and work. And we expect you to be in the community. So there's a lot of those things that we need to think about when we're making decisions, and know that everyone has a different time horizon. You and I have different goals, right? We have different, even though we have kids the same age, our goals might be different. So just know that those play a role.
Yep.
I think Cindy's question is great.
Why don't you read it?
Yeah, I can read it.
Go ahead.
Her question is, how much can a mortgage broker negotiate on interest rates for a well-qualified buyer? So there are truly two categories of lenders that you can work with: banks and brokers. Banks are companies that have employees, that have benefits, they have normally locations, they have fixed expenses. They are a one-stop shop for all general things due to banking. Hey, I have a check to deposit. Hey, I want an auto loan. Can I open a credit card? Those types of things. Banks in this marketplace tend to have a higher margin relative to mortgage brokers. Mortgage brokers are those people that can take a loan, produce a loan, or manufacture a loan and sell that or transition that to a lender who has very little cost to acquire that loan. When you have less wear and tear or man hours or female hours, whatever you want to call it, on a unit, and you can acquire that customer in a cheaper way through the wholesale or mortgage broker channel, mortgage brokers right now have an advantage, in my opinion, with the fact that they can have a smaller or thinner margin relative to the big banks that have a lot more expenses. So Cindy, your question, you could get a better deal from a mortgage broker as long as they have a competitive margin relative to the bank. Each mortgage broker has their own company, has their own set margin, has their own pricing structure. So I would say that you should, on average, get a better rate and negotiated price from a mortgage broker. Also, mortgage brokers can use any lender. So mortgage brokers have thousands of products and ways to structure loans. Banks may have 5 or 10 ways. Think of going to a barber versus a hairstylist. I know it's weird to say. A barber has certain styles of haircuts. I want boys flat top haircut number 1, or give me a mohawk or whatever. Hairstylists can shape your hair, can color your hair, can do whatever they want. And those differences can create a custom experience. So work with mortgage brokers if you have the ability to in your marketplace, and know that they have a lot more innovation around them because they're working with tens of 20s of partners that have different solutions and innovative products.
Yep. Good answer, Jimmy. Yeah. Hello from Virginia Beach, California, to bring prices down so I can buy a home. Yeah. I get this comment a lot because a lot of people think that in order to make housing more affordable, they want to see home prices decrease, not rates decrease. So I get it. Let me see if there's any questions here.
So yeah, I like the question from Mitch, the one from Mitch, please. If you don't mind, Mitch Olson.
Yep, go for it.
A lot of my friends decided to get armed.
So if you guys have any questions, put question in bold and caps, right? To help us here. Go ahead.
A lot of my friends decided to get arms when rates were around 5%. I fear for them and people in that position. Rates might not be 5% in 4 to 5 years. This is a great thing to address right now, which is really the mindset of your own personal goals. So the first thing we do as professionals, Jason and I both, are ask, what are your objectives, right? Each customer, consumer, client has a different objective. If you're planning to move in 7 years, do you really need a 30-year fixed loan if you're planning to sell the loan, right? So I would say, Mitch, I would want to know what your goals are for your friends. Are they going to be there for the long run? Are they moving? What's their plan? But in general, ARMs or are adjustable rate mortgages that have a fixed period of time, and then they have lifetime and caps that they can have in any period of time. So for example, let's say your friend had a rate of 4%, for example, for 5 years. That means in that 5-year period of time, that rate is fixed for 4 years. It's on an index and margin that then adjusts every year after that for the next 25 years. Well, that rate, unless we define that, could go up to a zillion, right? Well, the bank has to put, or lender has to put in caps. Those caps can be either 5% or 6% over the start rate. What that means is that over the life of the loan, the maximum cap rate, if the rate is 4% to start with, and they had a 5% max cap, would be 9%. In any year after the first year of adjustment, those caps can normally not go up more than 2%. So hopefully it's an easing into a higher rate if it is a higher rate, because payment shock is a real deal, right? If you go from 4% to 9%, you're over doubling your interest expense. So adjustable rate mortgages are not bad. You just have to make sure that you identify the objectives. So hopefully they have a plan, a backup plan, or a worst case plan. if rates continue to go higher, what are they going to do? And those are conversations they should have upfront before they even get into this loan, is make sure that they know the difference between a lower rate short-term loan versus a longer-term higher rate loan.
Yeah, there was a really good article I saw on resiclub.com. I'm trying to find it. I'll do my best to find it. But it basically shared like the number of people who are submitting loan applications using ARMs. And they had a really good chart over the past 2 decades. And they showed that back in 2004 through 2008, approximately 35% of all people submitting loan applications were doing ARM. Now it's around 7%. So the overall share of people doing ARMs is much, much lower compared to 2008, which of course had a lot of challenges, of course, back then. Matt, the mortgage guy. Do you know Matt, Jimbo?
I do. What's up, Matt? How's it going, man? Go Sacramento Kings.
We've done some videos together.
Yeah, good to see you. It's been about 4 years since I saw you. I think I saw you at the last event we had as an industry before COVID hit, literally 2 days before in Irvine, California. So hope you're doing well, Matt. Thanks for tuning in. We appreciate you and keep doing a great job representing your clients. So
absolutely. He has a YouTube channel as well. All right. So Jungle Book, we need rates to skyrocket so that prices crash hard. I mean, yeah, if we have like an environment in which rates were to increase, let's just say like the Fed decides to like increase rates. I mean, I don't think that's going to happen, but that would really shock the housing market, and that would cause prices to.
I would also I would also state something that's contrarian to that. If I have a rate that's 3% and I was planning to move in 3 or 4 years, and now rates are 10%, am I likely to move? Probably not. So if rates do skyrocket, I think it creates less volume and less homes on the market because people have now an arbitrage situation or an advantage to stay in their current home because they're paying 3% versus paying 10%. So I think we've already seen that happen after COVID also, where people hunker down, and now people are really contemplating. I feel bad for the seniors that are not able to make that move to maybe a more friendly home for their lifestyle, or maybe it's moving from a 2-story home down to a 1-story home, or being closer to their grandkids or out of state. It's a challenge. If rates have gone up double or triple from where they are, I mean, that's a consideration. You may have to go rent somewhere or go visit in a hotel versus go move physically somewhere. So that's a big thing that's happening to a lot of people throughout the country. And Jason covers a ton of people moving in migration patterns. I'd love on one of our next shows, Jason, to show the migration patterns that exist and where people are moving to and the reasons why, because I think that'd be helpful to show people that it's just not about interest rate being lower. It's about a life event also that can make someone make a decision to move. So.
No, for sure. And I mean, the people we've been helping buy houses in Sacramento, I mean, 90% come from YouTube. They're making like lifestyle decisions. They might be living in the Bay Area, for example, and they're kind of in a smaller house. Wife is pregnant, or they're expecting a new child, or they're getting married. They want more space inside and out. So they're looking at Sacramento because homes are so expensive in the Bay Area. It's just a different, if you have the ability to either like commute to the Bay Area a couple of times a week or work from home, then we get a lot of people who want to do that. All right, let's see if there's any other questions here. Question, have you heard of the 1-2-2 VA loan? And is it a good idea, or should you just go with a regular VA loan? I'm not too sure what the 1-2 VA loan is. Jim, do you?
I'm not sure what that means. I'd be happy to research it, RB. I don't know what that is, but I will. If it's referring to a buy down, that's the only thing I could think it would be referring to. What a buy down is a 2-1 buy down. 2-1 buy down is basically where you can buy the rate lower for a specific period of time. So let's say, for example, I had a 30-year fix. Sorry, I like to use my hands. A 30-year fix.
Do they have 2-1 buy downs for VA loans though?
They have a lot of buy downs. Each lender has their own specific niches. VA is regulated differently, but buy downs are just good to be aware of in general and what they mean. So basically, what we want to think about in a buy down is if I have a 30-year term, a 2-1 buy down means in the first year, I get a rate lower subsidized by 2%. In the second year, I get a rate subsidized by 1%. Then the next 28 years is back up to that initial rate. So in a 2-1 buy down, you will know the exact savings you get from doing that loan because it's calculated as interest rate minus 2% plus interest rate minus 1%. What is that interest difference for 2 years? So you have to look at the cost of doing that versus the savings. If the seller is paying for that, for example, it could be a really good thing. If you're paying for it and you think rates are going lower, I wouldn't do it because
Yeah, we see
they
a
have a
lot in
cost
new home
that you may be
construction.
getting the savings for anyways.
Yeah, we saw this a lot in 2022, like the fall and winter, where all these builders were offering this and paying for it. Because if you do want to do a 2-1 buy down, you do have to pay for it. And if the seller or builder is not willing to pay for it. New girl says we bought our first place at 17.5%. Is that 30-year fixed? Pretty wild. I think my parents bought their house in the 80s at like around 15%, which is absolutely crazy. The only big difference is the home price is increasing so much right now compared to what it was in the 80s, for example. Steve-O, hey, Jason and Jim. Nice for us to join. Nice for you to join, Steve. As much as I would like to move, high home prices and high interest rates keep us happy with our home. Yeah, I totally get it. Steve, thanks for joining. And new girl says, I warned a few people, they didn't listen. Now they have nowhere to go and rent is too expensive. Yeah, I would say my advice always is buy or sell when it's right for you, rather than now is a good time to buy or sell a house. Bam, that's it.
Bam, that's it. I don't know what that's it, but I like that. Bam.
Yeah. Sorry, I missed your comment. What else do we hear? Raymond, how's it going? Hey, good to see you here. Anyone has any question? Put question. 1984, there you go. A great year. 17.5% in the mid 1980s. Wild. Steve has a question. So question, Jason, I still like the name of the podcast I gave you. All right. I posted on my channel because I'm going to be making these videos as a podcast and trying to figure out what's the name of the podcast going to be. So I had a lot of good suggestions. All right. I still haven't done that. I need to figure out how to make this a podcast. I don't know. All right. I can pay cash for a home and still just can't bring myself to waste that money on home prices this high.
Let's talk about that actually, if you don't mind.
Yeah.
So this is this scenario right here that JB Velasquez, the economic term for what he's talking about is the opportunity cost on his money. So opportunity cost is what am I giving up to do something? So he believes, in my opinion, that he has enough cash, but thinks it's not a good idea to buy a home. He'd rather do that somewhere else, basically. So he's basically waiting till there's a drop in prices to get a better home value. So he believes there's an opportunity cost to keep his money in some type of other savings instrument and wait for prices to get better. We all have a different opportunity.
Or property taxes related too, though, right?
Yeah, we all have a different opportunity cost to think about when we're making any decision. And again, like Jason mentioned earlier, we all have a different time horizon for doing anything. So my simple way of looking at things, whenever I talk to someone about buying a property or refinancing, what is your long-term strategy also? If they're going to sell the property in a year or two, don't refinance. It's not worth it because you're going to sell before you even recuperate the fees and the cost to do it. So again, time horizon is important. What's that long-term horizon look like?
Johnny Fly, man. Love this guy. Everyone knows housing only goes up. People should just buy now and refinance when rates come down. Hi, Jason. Hey, Johnny. Johnny, man, so funny. All right. And then JBF Alaska had a follow-up comment or question. What is it going to take to bring home prices back to normal? I would say, like, what is your version of normal? So I would say if in order for home prices to decrease, we need to see supply outpace demand. It's like simple, like economics 101. You need to see more people list their house for sale, and we need to see the demand side fall in order to see prices decrease. And we are seeing inventory increase on a national level up by about 25%. So we're seeing inventory rise, but we're also seeing an uptick in contracts being signed as well. So in order to see a housing market crash, you need to see new listings basically going like this, or inventory levels going up like this, and then also a decrease in demand. So in other words, supply far outpacing demand. That's a scenario in which prices decrease for any asset, really. Anything you want to add regarding that, Jimbo?
Nope, that sounds good. Can you go to the anti-crony capitalists comment? Okay. So
right.
This is interesting here. The last time rates fell, so did prices. Well, here's what happened. That was a big issue around a surplus in inventory. So at that point in time, 2006, 7, and 8, there was too much inventory. So when people started getting into defaults, there was inventory to begin with, and then the banks dumped more inventory on that. So the government had to lower the price of getting affordable financing to try to slow down the crash. Unfortunately, it was such a systematic crash. A lot of fraud happened. Big Short and other movies like that are great movies to watch. You have to think about that was one of the reasons why rates were dropping significantly. It was like catching a falling knife. When is that going to stop? So that did rebound in 2010 and 11. And some people that got in those years did very well. They saw about a 20% appreciation year over year from 2010 to 2012.
Yeah, here's a really good chart showing like what was going on back then. So here is this is like a chart I found on calculatedriskblog.com, and the source is the National Association of Realtors. This is the amount of houses for sale ever since 1999, and you can see, just like Jim is saying, surplus of demand.
Wow, it's like I lived through. It's like I lived through that or something crazy like that.
Yeah, right. It's like you were a loan officer back then.
It's like I was. Yeah, it was wild.
Yeah, I mean, 07 to 09. I mean, it's absolutely crazy. I mean, nearly 4 million existing houses for sale, whereas the NAR just announced, what was this, a few weeks ago, that for the month of February, we had around 1 million. So right now, 1 million, far below, pre-COVID levels. So from 2013 through 2019, around 1.5 to almost 2.5 million houses for sale. But that pales in comparison compared to the giant increase of homes for sale right before the Great Recession.
This is a very good graph to show. Simply look at where we were and why there were issues, and look where we are today. Yep. And again, we're at the lowest levels of inventory in the past. Can you go a little? What's the farthest date? I can't see it on my screen, but
over here on the left.
Yeah,
it's January 1999.
Got it. So that's huge, right? Look at the units. I mean, this should show you again. And our population continues to grow. The economy continues to grow, right? There's a consumer price index where costs go higher to live, right? Everything's going higher. So this chart should show you again the opposite of prices falling. If this chart was opposite, if you saw the trend opposite where rates or inventory was going a lot higher, then yes, I would agree that there's a chance that there could be a correction or softening in values. But this clearly shows to me, if you look at every tranche on the way down, it's almost a perfect kind of trend. Every tranche going down keeps going lower and lower. So again, will that stop? It'll only stop if more inventory is created. So that's what we need to see, is builders need to be more incented more to truly do more stuff to help make a difference and get inventory out there. So I would love to see the government, local government, and federal government step in and infuse some more legislative and monetary policy around this to make it be something easier to get a hold of, but it's not. And the average house takes about 9 to 12 months to build.
Yeah, I helped I'm representing someone, I should say, who's buying a new home construction. It's a dirt lot, but it's not going to be built until I think December this year, I believe. And they got in contract a couple months ago. So yeah, it takes a while to build a house. I saw a question here. Let me go back here.
Let's talk about that. Let's talk about that real quick here. So before we get to this question, you can, if you're buying a new home, I think VA mentioned this earlier. How do they get best rates on buying a property with a builder? You're able to get on new construction a forward lock commitment of up to 180 days in most cases, which means you can lock the rate of your property 6 months before it's completed. So if you're worried about qualifying for something, you can do that, what's called a forward lock commitment. And again, it's available only for new construction, but it's a good way to give builders and buyers some confidence that they're going to have a buyer when the house is done, and that the buyer is going to want to still buy the house because they still qualify for it. So.
Yeah, I mean, I personally, I think we need to have like more houses being built in order to help with this affordability issue we have nationwide. All right. Vito Carlo, thank you for your question. Can you explain the new buyer agent commission rule? When will it take place? Will it affect the listing price? The previous 2 live streams Jim and I did, we talked about this. So you can take a look at my channel. Just go to my channel and then click on live. You can see my previous live streams. But in general, this new rule is just a proposed settlement offered by the National Association of Realtors. It's not finalized, but it appears it will be finalized. But it won't take place until potentially sometime this summer, mid-July potentially. The settlement, there's basically 2 things. So there's one of them is that as a listing agent or an agent representing a seller, you cannot put, or actually there will not be a field on the MLS in which it states how much commission is going to go to the buyer's agent. So that field on the MLS that I can still see today on my local MLS will be gone. Number 2 is that it's going to require home buyers to sign a broker agreement with their agent. So this agreement will stipulate how much the buyer's agent is asking for compensation. And we kind of talked about it at great length, but that's kind of the 2 main things. Those are 2 main things that are impacting home buyers in the market. And how will it affect the listing price? I don't think it will affect the listing price whatsoever. So let me give you an example. Let's say I decide to sell my house, and for whatever reason, sellers are not offering or not willing to pay a buyer's agent. I am not going to discount my price or my asking price by X% or X dollar amount just because I'm going to save money by not paying a buyer's agent. So Jim and I talked about this at great length. In my personal opinion, I think Jim agrees with me regarding this as well. The big winners regarding this settlement from the National Association of Realtors are listing agents if they decide to represent the buyer and the seller potentially. But the big parties at the biggest disadvantage regarding this are people who are have minimum down payment, such as a VA buyer or an FHA buyer, in which potentially, if there's a scenario in which they have to pay their buyer's agent on top of their closing costs and their down payment, they're probably not going to have the funds to pay their buyer's agent. So those people are going to be really going to be impacted by this proposed settlement. But again, just a proposal. Nothing's been changed as of yet. Anything you want to add, Jimbo?
No, that's accurate.
Cool.
And we'll, as more and more comes out on this topic, we'll have more and more insight for you guys, provide more and more articles related to this, and make sure you have facts.
Yeah, absolutely. I think that we plan to probably talk about this at least once a month because there could be some changes and some new announcements. So we'll keep you posted. So JBF Alaska also says, as a home buyer, can I get the rate the current owner has? So he or she is basically talking about an assumable mortgage. So in general, and Jim probably has more insights regarding this, but so if a homeowner has a VA loan or an FHA loan, those are assumable loans.
Potentially assumable, depending on when they're originated. Yes.
Yeah. So in contrast, so a conventional loan are generally not assumable. So maybe you can add some context regarding what
absolutely.
that looks like.
So one thing to be aware of with assumable loans is loan limits have gone up year over year. They take the average household price in your county, and those loan limits, like we've talked about in a previous video, have gone up year over year. In California, they were very low for a long time. Now, for example, in California, the loan limit for a conventional loan is about $1.1 million and change for a loan limit of a conventional average price home in certain Bay Area markets.
We take a step back here because you need to probably explain the jumbo loan, the limit. You're basically talking about the limit in which you can have a conventional loan versus a jumbo or a high balance loan, more or less, right?
Correct. So let's think about 10 years ago what those loan limits were. They were about $323,000 or $417,000. So that loan that a seller has had for 10 years that was assumable on a VA loan at 3%, for example, has started to be paid down over that 10-year period of time. So as it's paid down, the remaining outstanding balance is lower. And if the loan limit was 322, it's probably a loan of $180,000. Well, that house value has gone up dramatically. They may have bought the house for $500,000 and the house might be worth $1 million now. So just because I can assume a loan doesn't mean I can afford the down payment, because the assumability is only on the remaining balance of that loan term and loan amount. So again, if I have a $180,000 balance remaining on a $322,000 originally balanced loan, that's going to be a huge down payment. So is someone going to put down on $1 million purchase? Are they going to put down $820,000? They probably can't afford it. So the assumable loans are being phased out over the life of their term. So while they are available, it's very rare right now to find one that works for the numbers for someone buying a home.
Yeah. So let's just maybe say an example here. So if the house is, let's just say they have a $200,000 remaining balance on their mortgage, but their home is worth $1 million. You're saying that 200,000 is assumable, but not the the $1 million,
the original balance that they had.
Yeah, so they'd have to put down the additional money down, right? So the $800,000 less whatever their down payment is what they would have to put down, right?
Exactly right. So that's the challenge, is that it's great to have a 3% rate, but if you got to put down $800,000, that's not helpful in my opinion. So
yeah, well, how many people have the funds available? Yeah, if you have a FHA buyer, then how many people would have $800,000 available to put down? It's not going to happen. There could be a scenario in which someone bought a house at the peak in the summer months of 2022, in which their home value is more or less in line with what we're seeing today potentially, and it could work out. But houses that have been purchased a long time ago, highly unlikely it'll actually work out. And this person has, I heard that Biden is pushing for increasing the home inventory of 2 million to reduce the prices. Will that be possible?
Sure. Show me the money. Like, show me how. Are they going to build these things overnight? Again, I think this would be a great solution. It may affect certain markets in a bad way, though. If you brought on if a market only sells 200 units a month, and you bring on 1,000 new units, that could actually have a negative impact to that local economy and local property tax base, ironically. So again, it's supply and demand at a big national level. Then you look at the micro level and say, how will more inventory help or hurt the economy? 9 times out of 10, it should be helping the local economy, but it could hurt in some examples if you already have a lot of product that's coming online. But yes, I agree. We need to get more houses built. It's very important for us to do that. And we needed houses last year, the year before. In California alone, we're short about 1 million units year over year.
Yeah, so I can't remember his proposal. I made an whole entire video about this. So if you leave a comment below or leave me a comment in the video, I can provide a link to that video. I can't remember the specifics regarding that. And I think that the announcement from the White House was kind of vague regarding how they're going to get there. Yeah, I'll try to find that video for you if you leave me a comment below. All right, let's see other questions. All right, we have about 10 more minutes here too. Tony Piazza, thank you for your question. And we have 200 people watching this live stream. It's awesome. Thank you so
guys.
much for
We
watching.
appreciate you guys. Thank you for being
Yeah,
on.
we appreciate it so much. And hit the like button, please, too. Question: when or if the Fed drops rates, how much will that affect rates when they are no longer buying bonds and houses on the secondary market? And
Okay, I can explain this. Yeah. Okay.
Take it
So
away,
Tony Piazza, I hope you're on a mountain bike right now. That's a cool photo.
Yeah, it is.
So you're talking about quantitative easing or quantitative tightening. When the government is providing quantitative easing, they are putting more money into the markets, which means they're lending money at a cheaper amount and they're buying more properties. They're buying more mortgages, is what that refers to when they're buying bonds. When there's quantitative tightening, that means that they're lending out money at a higher rate, so less of it, and they're buying less debt, which means other people have to buy the debt, and that cost of buying the debt is probably needed to have a higher return than what the government's wanting to make. So those two factors, when you look at the government having quantitative tightening, that is truly why rates have gone up so dramatically, because there was not a lot of people wanting to buy a rate. If inflation was at 9% and you were locking in interest rates at 4%, that means you were losing 5% on your money for the term of the loan. That's not a good loan. That's negative arbitration. That's a loss situation. We don't want to have that if you're an investor. So if and when the Fed drops the rates, I believe you'll see other market players or competition have to take a lower and lower return. Remember, when bonds trade, the person who gets the bond or the mortgage to then collect the payment for the next 30-year term is the one who bids either the highest to get that debt or offers the lowest interest rate to sell the debt. Those are all free market economy principles. So I believe when the Fed lowers the rate, that means that people are going to be looking for the best return that they can get locked in. So there'll be competition to get those interest rate bonds as they keep going lower. And so I think you're going to see more buyers ironically come back in the market for buying loans. It should be more fluid market conditions because more people will have the ability to buy loans. And I think the government is going to flip-flop their interpretation of quantitative restricting or tightening, and also probably help be a backstop again to buy these bonds to create velocity to get people in and out of properties.
Thank you, Jim. All right. From Steve-O, do you think we should ban institutional buyers?
I got one for you on this one. This is crazy.
All right, cool.
Guess how many non-human beings, what percentage of the properties that exist in the United States in terms of units are owned by non-human beings, which means are owned by institutions or funds? What percentage?
Of all houses in the United States? Isn't like 2%, something like that?
28%.
28%?
28% of every unit available in the United States is owned by either a corporation, a REIT, a fund, a non-primary residence owner-occupied human being. How crazy is that?
Where'd you get that stat from? I haven't heard that high.
Think about that. Think about supply and demand.
Where'd you get the stat from? Where's the source?
So if you're, we'll put it on the chat later, but if you are an institution and you know that inflation will continue to happen and you know supply is not being increased, as an investment, you can buy a property at over 100% the value today because you know that the value is going to be higher down the road. So that's what a lot of these REITs and hedge funds have done is they have a secured asset they can rent out and collect income to pay the interest. And it has been a relatively safe investment for them the last 10 to 12 years. It wasn't the case in 2007 to 2010 when everything dropped, but that's something to be aware of. So
for sure. All right. And Vito, Jason, you're the man. Thanks for the explanation.
What about
You're
me?
more
Do
than
I get to
welcome.
say, what about me? Come on.
Jim's
You
the
don't-
man too. Yeah, Jim, you're the man, dude. I'll say it. Jungle Book question. You continue to say we need more houses. We do. Would banning short-term rentals, institutional investors, and international buyers fix this problem? Fix this problem. The problem being
So if we
affordability.
got rid of the institutional side of the competitor side, would this help alleviate the problem? Yes, it would. So when there is a foreclosure or short sale or repossession of a property, every financial institution and servicer in the United States has to first allow that property to be potentially bought for a time period by a primary resident owner occupied household. So the government's trying to do their best to control the sales side of that. But if we banned everyone from buying today that's in this category, it does not eliminate the fact that you have 28% of properties still owned by these non-human beings, right? So that's still the effect. We need inventory. We got to get through that inventory crunch. What you're starting to see with short-term rentals, I was in Nashville, Tennessee last week. What you're starting to see is them tax those rental properties at a much higher level. So it disincents those people that own those properties to rent them out to Airbnbs. It incents them more to rent them out to long-term rentals. So you're going to see local taxation changes to help create that change in not using Airbnbs. That's what I believe you're going to see.
I think we're seeing that in California too. Didn't they pass a law regarding that? I know it's in Palm Springs. I don't know if it's statewide or not, where they're taxing short-term rentals, which is going to hurt some of those.
Each city has their own ordinance around it.
There you go. Yeah. Ben Jammin has a question. With inflation and the cost of all things going up and minimum wage going up, et cetera, how much can house prices even fall in comparison to everything else? To me, it's just a balance between supply and demand. We have an imbalance right now, which we have an imbalance for a long period of time. The cost of inflation, consider how much home prices even fall in comparison to everything else. Yeah, it's a really good question. You want to take a stab at this one, Jimmy? I'd kind of go back to, for me, I would go back to like the supply versus demand. And in my opinion, the direction of home prices is going to be dependent on the unemployment rate, mortgage rates, inventory, and of course the balance between supply and demand. But yeah, we're seeing some improvements regarding inventory levels, but we need to see more improvements down the line.
Yeah, I agree. Everyone has different objectives. And again, yes, if you're on a fixed income and these things keep going higher, it does push people out. And that's the biggest fear for the government, is to push out seniors, people on fixed incomes, people on welfare programs or Medicare, things that have a fixed element to them. That is unfortunately the challenge. So that's something that we all don't want to see. Hyperinflation or stagflation, those are things that are very bad for any of us to be part of.
Definitely true. Raymond says, get those likes up. Yeah, hit the like button. Appreciate that, Raymond. Thanks very much for joining. So we're going to kind of wrap this up here, but I want to see if there's any questions here.
Justin brings, oh, sorry, go ahead.
Yeah, DJ is a Terminator. Question: buying a new build townhouse for $300,000 on a VA loan with $5,000 down. What % drop makes sense on when to refi?
So there's a fixed, there's a DJ, this is a great question. And thank you so much for your service or your family's service to our country. Yeah. We appreciate you. Number one. Number two, all these programs that the VA or FHA or any of these lenders roll out have a net tangible benefit calculation. What that means is you have to have a certain savings over a certain period of time to be able to do it. Otherwise, they don't want lenders churning loans. They don't want a lender getting more reward than you as the veteran. So that difference on a VA IRRRL, which is known as interest rate reduction loan, has to be 0.5% or more in savings on rate, with a break even of less than 36 months of the cost versus savings. So if it costs you $10,000 and you save 0.75% of the loan rate, you have to recuperate that $10,000 cost within 3 years to be able to do it. And there's a cooling off period, normally of 270 days. You have to wait to be able to refinance with a VA loan. We help a lot of veterans. I love helping veterans, seniors, and first-time home buyers. Those 3 buckets are my favorite because veterans especially have protected our country. Seniors have helped us establish these communities that we live in. And first-time home buyers, there's an excitement there. We get to be involved with a big decision in life.
Absolutely, 100%. Alaska, thank you both for a great session. Yeah, thanks for tuning in, and everyone watching today's video. Really appreciate you guys. We're here for an hour, and again, the whole purpose of doing these live streams is to provide value and answer your questions, because sometimes it's so challenging answering comments, because I could spend all day, every day answering comments. That'd be my full-time job. All right, Joey. Love your content. Thank you. But random question, is it a good time to build? I know that is location based, but just in general. To build, I assume you mean buying from a home builder in which you're going to be building your own house. I would say it's really a personal decision. I would say that here's what I tell my clients. I say that if you want to get a good deal on a brand new house, try to find one that's already completed, in which the builder has all these costs associated with building the house, and therefore they're much more willing to negotiate with you compared to just dirt, in which they have basically, barely any costs associated with that. So if you guys are looking to buy a brand new house, then my advice, try to find a house that's actually completed, because you can actually negotiate a lot more with the home builder. Let's see
I
if
like Joey's
else
question. Joey's question, maybe our last question here. And we can use this, Joey, as a one-off that we can send you some information about, but we can also do a little video about it. The cost of waiting is the main question. The last one from Joey at 502, Jason.
Okay, there you go.
And this,
you're welcome, Cindy. Go ahead.
Thanks, Cindy. So my wife and I can afford to buy a home in San Diego between $700,000 and $800,000. But the type of homes we would want to live in for the next 5 to 7 years is more like $850,000 to $950,000. Do we wait or buy? So my first question's, that's a good thing. We know your objectives, right? Your objectives are to buy a bigger home. The thing we want to think about is how much money you're losing by waiting. What is the cost of waiting for you? That is the most important question. If you can give Jason your personal information email, I'll send you an example of the spreadsheet. It's pretty cool. It will show you the cost over the next 5 to 7 years of how much you would pay in rent. You have to give us a rent number, obviously, relative to the cost you would have paid in a mortgage, and take an average historical appreciation rate of the house appreciation. There's a thing called the rule of 72, where every 7 to 8 years, things double in value. So that house you have right now that you're buying potentially at $700,000, $800,000, may be worth a whole lot more by the time you want to buy the next house. So to me, you have to look at the cost relative to the opportunity to make equity and what the expense is for your rent. If you have a $2,000 rent right now and you're going to be paying $6,000 a month in payment, yeah, that's something to consider. That would be a $48,000 difference every year in expense. So you have to think about rent versus your new payment versus appreciation, and potentially what interest rates will do. So we can help you with that one-off if you like. Bad way to end this. Okay. So anyway,
I have a different take than Jimbo.
You have a different take.
So
Okay.
I understand like the opportunity costs of renting versus owning and such. But to me, I read this and say that 700 to 800,000 is not a house you want to live in. You want to live in it for potentially less than 5 years, because you're talking about 5 to 7 years is a much higher home price. So my advice, if you guys want to be conservative, don't buy unless you plan to own the house for at least 7 to 10 plus years. So if your budget is 700 to 800,000, but you only want to live there for a few years, then why would you buy? In my opinion, because who knows what home prices will be in 3 years. And so I advise to just wait. If you feel that the price range of 700 to 800,000 is a home you only want to live in for a few years, and then you can't rent it out and have at least a positive ROI or a break even in your housing payment. That's my take on that.
And that's what I love about real estate is the right answer is the one that's right for you.
Yeah,
we can always
exactly.
provide the tools. And this is the first time Jason and I have disagreed on air. Again, just have the tools available for you. And we're going to do a dance off next time. We'll do a dance off. And,
no one wants to see that.
Just teasing.
No, this is a good thing about having these collaborations, because everyone can have their own take and people have different opinions in the comments, which is totally fine. I mean, I welcome having like different perspectives and everything, which is, I think, is conducive to learning and just in general too. So anyways, it is 5:07 and Jim Black and I have to get home to feed the kids. So yeah, thank you, Jim, for joining me in the video, and everyone who's watching today's video, then please like and subscribe. If you guys got any value out of today's video, then please hit the like button. Also consider subscribing as well. And Jim, yeah, thank you so much for joining us in today's video.
I think we'll do our next one live, possibly next week, live in person. That's a possibility.
We might. Yeah, that's a thought. Maybe we could do that.
Do it. Come down.
Yeah, actually, maybe we'll do that. That'd be fun. All right. Thank you, everyone. Have an awesome day.